Thank you for joining OTC Markets and D.A. Davidson as we discuss bank stocks in today's volatile market. We appreciate you taking the time to join us and hope you and your families are staying safe during this time. I'm Laura Hamilton, Vice President of Corporate Services at OTC Markets in New York City. Joining me today are Michael Natzik and Tom Dooley, both with D.A. Davidson. Thank you for joining us today.
Thank you, Laura. It's a pleasure to be here this morning. Our overall goal this morning is to help answer some of the questions that we've been receiving here with regard to the recent market volatility. In short, why is my stock down? We've received this question many times from many of the banks we work with, and we thought this webinar would be a great opportunity to address that question and those issues. All right, well, a little bit about D.A. Davidson, just to start off here, is D.A. Davidson's a national firm with deep resources across our system. Currently, we're in over 26 states, and we continue to grow. We're committed to community banks and their markets, and we also make markets in probably one of the largest numbers of community banks across this country. This is a commitment that D.A. Davidson has made as a firm, and we continue to grow that footprint across the space.
Great. Thanks, Michael. So a little bit about OTC Markets. As many of you are currently traded over the counter, you understand that we have 3 different market tiers. We trade 10,000 securities across our OTCQX, OTCQB, and Pink marketplaces. OTCQX is our highest tier with the highest financial standards and the closest to trading on a national exchange. No penny stocks are allowed to trade here, and we allow banks to trade here if you're under 1,200 shareholders of record to not have to be filing with the SEC. Again, that's in part to the Jobs Act of 2012. OTCQB is our middle tier in our venture market, primarily made up of pre-revenue healthcare and technology companies. And then Pink is our bottom tier. It's a default market with no rules or regulations to trade here. The majority of stocks that trade here are under a penny. Flipping to the next slide, I'd like to go over how OTC trading actually occurs. So as a company, we have our marketplaces OTCQX, OTCQB, and Pink in one business line. Our trading platform called our OTC Link, which is an ATS, alternative trading system, is in a different business line. Many people do not realize that when a trade occurs, it happens over the OTC Link trading system. Trading over the counter is very similar to trading on the exchanges. You can place an order via your brokerage account, and the trade flows through to market makers. While the orders flow through the OTC Markets trading platform, note that OTC does not, I repeat, does not price the transaction. The prices are determined by the market makers. Michael, I believe you had a comment to make here.
My comment here is simple. As we can see from the graph, this is a rather complex process. In the old days, defined as maybe only 10 years ago, it was a much simpler process. But with the advances of technology and regulation, the trading of OTC stocks as well as stocks in general can be very complex. And that's really what we're trying to express with this slide.
Going over to the next slide, looking at OTC trading volumes, 91% of OTC volume is in non-penny stocks. This is why we see more volume on OTCQX, since penny stocks are not allowed to trade there. Most trading is in exchange-like securities outside of banks, where we have large international companies that trade their F shares or ADRs, like Roche Pharmaceuticals, Adidas, and Heineken. 2020 volume is up significantly due to the current market environment. Going on to the next slide, Michael.
Sure. Thank you, Laura. What we wanted to do here with this slide is just give you a little bit of an overview of the importance of a market maker. We all ultimately end up with the majority of orders in OTC stocks, which involve community banks. The role of a market maker is to match up buyers and sellers in a stock and stand ready to execute trades at the quoted price. Market makers typically need to be ready to sell or buy based on their size in the stock. And even though they may put a quote out there, that quote may not necessarily represent the official market. The way the market works is it always takes the best bid and the best ask, and that creates that market. In the recent market, these having our partnerships, especially with our banks and our issuers, has become even more and more important. And the reason for that is as we work through these markets and manage our risk, being able to utilize all of our tools in our toolbox becomes even more important. As a market maker, you also become an investor resource. For many of our banks, they'll utilize us as an extension of their shareholder services when somebody's looking at purchasing or selling shares, if they're looking at transferring their shares, replacing certificates, all encompassing. So whereas some market makers out there are just basically in the system, we look at it as a true partnership with the issuers and the banks that we work with. Tom, I'll go ahead and pass it over to you.
All right. We talk a lot about market makers, and sometimes we kind of forget, since on the brokerage side we deal with it every day, not everybody really follows along. And so it occurred to me that if you think about the business of market making and what we do, and you think of it in banking terms, that might be helpful. And so if you think of the bid, market makers post bids. And really, that's they're trying to acquire inventory. The bid side of the market, kind of think about deposits. If you want to increase your deposits, you raise your rate. Market maker, we would raise our bid. So we'd hope to attract inventory that, in a perfect world, we would turn around and sell at the offer, and that would be somewhat like making a loan. And so we kind of control our inventory through the price movement of the bid and the offer. So that's, that might be a little easier to understand. Then in addition to your traditional market makers, we've got electronic communication networks. These are firms that are executing orders for other broker-dealers, but they're not necessarily acting in a market-making capacity. They're not taking inventory. They're trying to match orders. And we'll probably get into a little more later, but that's really where one of the failures in the market has occurred in the past month. There is no buyer to match this seller up to, and so the ECNs have really had to trade, with the other market makers as opposed to these other orders or these clients that would be in the market. So. You had brokerage firms and ECNs trading the same shares over and over and over. Something else that maybe is not clear, we had questions about this a lot, about committing capital and buying stock, and Michael touched on a little bit. Market makers really only committed to buying the number of shares that they've indicated they're interested in, and that's called the size of the market. And so, it can be as small as 100 shares, it can be much, much larger, but basically, market makers are not required to sit in the way of the market and buy all these shares. So that there's some misunderstanding there. So if you think about market makers and ECNs all functioning in the same market, you've got different firms competing for the order flow, just like you might have different banks competing for loans and deposits. And so, basically it's all aggregated in the quotation system. Everyone's pricing, and as Michael mentioned earlier, customers are entitled to the best bid and the lowest offer when they're out executing orders. If you could look at this slide here, this is Victory Bank Corp. It's a small bank, about a $300 million bank in Pennsylvania, and this is what the quote would look like to the dealer network. And so if we look at the left-hand side, we have bids. These are the prices that different market makers are willing to pay. On the top here, we've got the bid at 705 DADA, that's DA Davidson. Next to that, we have our size. So we are saying we will buy at least 500 shares of this stock at 705. Let's assume we only wanted to buy 500 for sure. If someone came in and they had 1,000 to sell, after we bought our 500 at 705, we would get out of the way or disappear and move our price down. The next price would be 702. And so using that same 1,000 shares, if we bought 500, this next dealer, Monroe's, indicated they'll buy 100. Now they've got to move. The next price is 702 for another 200, and you can see how these orders work their way down through there. If there were, 5,000 shares for sale, you can see how they would burn through these size numbers very quickly, and then get down to the 100 at $7 and then 100 at $5. And this is where you saw the volatility in the markets certainly last month and still today. But that's how this works. If we look at the other side, the offer side, at $7.35, you can see that a market maker's got 1,500 shares available for there. The next market maker has 1,300 shares for sale, $8.99. And so as these orders work through these size numbers, that's how you get the price movement in your stock.
Thank you, Tom. This is Michael again. As you could imagine, our traders are a little busy right now with the current markets and keeping them definitely on their toes. As such, what we asked our traders to do is aggregate some thoughts for us. These come to us from Eric Madsen, the head of our equity trading for D.A. Davidson Wealth Management, as well as from our market makers on our trading desks. Some of their observations that go with regard to the recent trading was the decline that they saw on the desk was unprecedented. Indiscriminate selling and fear of the unknown was definitely out there, not specific to only the OTC stocks, but some of the larger caps as well, many down for as much as 60%. The one thing that they mentioned that was different from our 2008-2009 financial crisis was that took place over a period of months, whereas this event took place over a period of weeks. Now, we're still seeing a lot of volatility in the markets, but what we saw as far as the most aggressive selling took place at over a very short period of time. The other thing that our traders commented on was the order handling protocols by wholesale market-making firms who typically don't have any relationship with the bank or the end client, and they very much favor speed over price. And they also indicated that the trading regulatory environment forces speed over quality as well. One of the other comments that came from one of our traders was the use of market orders versus limits, in which they saw a lot of market orders coming into the market. And on thinly traded stocks, market orders can be quite dangerous because the orders come in very rapidly into the marketplace, and by not having a limit or a floor on those, they come and they hit the bid so quickly that traders have very little, if no, time to react. And then they indicated that the spreads have widened quite a bit during these times of uncertainty. Typically, market makers will buy 100 shares or whatever they're good for and move down $1 from their current price. But in this environment, what we're seeing market makers move down as much as $3, $4, $5 in price, just basically because of the manner in which these orders are coming in and the rapid speed of them. And then during the same time, we're seeing that the market makers are getting tapped by risk managers throughout the industry. This isn't just, I'm speaking as the industry as a whole. We noticed that firms that are typically more aggressive in markets are being very defensive and in some cases passive, just to try to manage the risk because those markets are moving so quickly. And and the supply is although small, can be overwhelming in a thinly traded stock. And so in many cases, because we don't know the size of the orders, the traders are required to move aside so they can breathe a little bit and see what's happening with those stocks. So that gives you a little bit of an overview from what they're seeing from the trading side. I want to thank our equity traders for their hard work that they've been doing during this environment, and know that they're working for everybody here, trying to get our stocks in good order as we move through this difficult season.
I'm going to look at slide 11, what we call time and sales, and I'm going to try to explain in a real case scenario of this volatility and how these orders, when the market's not functioning right, can really create problems for the market. We're looking at a bank in Michigan, Keweenaw Financial Corp. Hopefully I pronounced that correctly. It's a bank in the Upper Peninsula of Michigan. And basically, we're going to show how a very small order can have a very, very impact on the price of the stock. If you squint and we look at this March 18th, the order started at 10:44 and 12 seconds in the market, and you see 100 shares come available for sale. That gets executed. A few seconds later, we see another $145 that gets executed, but that has cleared out the size at $45. If we go a little further up the slide, the next shares trade at $40. That was just a few seconds after that. Another 100 share trade at $40. Now all the size has been cleared out at that level, so the next bid is $36. And we can see still a few seconds later, the last piece of this stock, 68 shares, trades all the way down at $36. So in 21 seconds, the stock traded as high as 45 and as low as 36. This is obviously from the speed here. It's most likely all done by computer. No one had an opportunity, no market maker, to really step in and say, hey, wait a minute, this stock is down, 10 points, almost 10 points in a few seconds. Maybe I should have bought more. Maybe I should have stepped in at more at 40, but they had no opportunity. And so, this scenario has played out over and over and over the past 6 weeks or so. Michael, you want to talk a little more about what we've seen in the decline?
Sure, Tom, thanks. As Tom indicated on the previous slide, and then also from Eric's comments, timing does make a huge difference here. And this is one of the things that we've seen in this market. And the one thing to keep in mind is, when traders are getting hit with stock, they typically have seconds or even shorter than that, believe it or not, to respond to the markets. This makes it increasingly difficult, especially if you have multiple stock moves all at once that are coming from different directions. In comparison is when we looked at the financial crisis, that happened over a longer period of time, whereas here what we've seen recently has happened very quickly. And because of that, the market makers and the market as a whole just only has mere seconds to respond. You have to sit back and then reassess. So what I wanted to do is walk through a little bit of our assessment of what we saw from the markets here. Is we saw volume and inventories dramatically higher than what we've seen over before. We've also seen the same blocks of stock move very quickly. What a lot of this has to do is going back to that risk management piece, is that market makers are trying to support stocks and support inventories, but at the same time they're getting hit so quickly. It's very difficult to manage that in a quickly moving market. The other thing that to think about is the shareholder base that's out there. Who owns your stock? Institutions, in many cases, have different metrics as to why they're going to sell a position, and sometimes those positions are very large. And if we don't have the buying interest on the other side, it's very hard to support those stock levels. And then the other thing is inventories across the country, across the market makers, tend to build up quickly. And execution prevails far above anything else, meaning that the market is looking for and the sellers are looking for quick executions. And bottom line is you can't take this personally against your stock. We've seen great stocks out there that are great performers in the market that have just gotten hit very dramatically, and they're down 30 to 40 to 50% depending on the stock. And in many cases, it's not a matter of that bank is a bad performer by any means from a fundamental standpoint. It purely has to do with the stock that's come into the market and the manner in which it's come in. One of the going back to Tom's previous slide for a second is you can see that all happened within a 21-second period. In a very quick-moving market, we don't know if that's going to be 500 shares or 50,000 shares. And so that's why the market will retreat very quickly as it's waiting to see how much stock is there. And when that's happening on a trader's screen and there's, that's happening to 30, 40 stocks all at the same time, you can see why it's so hard for them to react, and they're going to be very risk avoidant there. So, Tom, I'm going to go ahead and turn it over to you as what we can do as an issuer.
Well, I did want to comment a little bit on this current slide. We talked at the top there about the volume being 4 to 5 times. I think people in our industry and bankers certainly understand this. We kind of talk about double volume, and so if you see your bank traded 20,000 shares last month, people know pretty much assume, okay, that's really 10,000 shares. That's a buyer and a seller, and that's is reported as 20,000 shares, and that's not completely exact, but it's our best guess, and so that's kind of people in the industry understand that. What I've seen over the past 6 weeks, the volumes are sometimes 4 or 5 times what they had been previously, and it's not necessarily an increase in true volume, but we've seen a number of cases where it's like hot potato. You'll see the same 100 shares of stock trade over and over and over as people. Traders see this 100 shares come into their inventory, they buy the minimum, they don't even know they bought it necessarily. 5 minutes later, they figure out they have it, they don't want it, they just sell it to the next guy. And so you might see, trade volume of 500 shares, and in many cases, that was the same 100 shares going, being sold from dealer to dealer to dealer. So I think the actual volume for a lot of these banks is a fraction of the reported volume, and so it's kind of hard to judge really what is happening. I think you would agree, Michael, that the volume has not been as large, and so there's not this huge overhang in the market necessarily. It's really just a function of how these trades were reported.
Exactly, and I think what also has come into there, Tom, is it's the fear of the unknown. What's behind that trade? And so when we see these pieces hit the market, sometimes we don't know if there's more behind it. In the old days, you would have picked up the phone, you could have called another dealer and got a better feel for what they have. In today's markets, with the technology and the regulations we have, we can't make those phone calls. So it makes it markets tend to be a little more difficult in that regard.
Well, I think to manage the risk, we have to assume the worst, not the best. And so when someone, especially electronically, you get an order for 500 shares, you've got to assume that's 5,000. You can't base your decision on what the trader's actually seeing, and so that really causes firms not to want to commit their capital because nobody wants to grab a falling knife, and that's really what we've had here.
I would agree.
I think we'll have Laura chime in here and give us some suggestions on what an issuer can do to alleviate some of these problems.
I think the best thing that banks can do right now, obviously there's a lot of press right now with the Paycheck Protection Plan and the CARES Act. Obviously those funds have now been exhausted, and we really appreciate what all the banks have been doing to help your local communities. I think what you can continue to do to help yourself, though, is to communicate. While stocks have been fluctuating pretty rapidly in the banking sector, having press and having continual press is only going to help support your bank stock and having that communication line open. If you are currently traded on OTCQX, we do provide interviews for the bank, for your CEO to complete or your CFO. Please reach out to me, and we're happy to facilitate any of those. Anything that you do on LinkedIn, recommend highlighting it on those social media platforms. We're happy to reshare anything that you post to try to help tell your story to a broader audience. And just making sure at the end of the day that you're taking care of your employees and your customers. We've even seen banks that have made COVID-19 decks and communication uploaded to their OTC page. Tom and Michael, turning back to you.
Thanks, Laura. Just a couple other thoughts that I had here on this slide is this was a perfect storm what's happened in the market here in the last several weeks, and in the sense that that we had many insiders that wanted to buy their stock, or banks that wanted to buy their stock, but because of it being so close to quarter end or over quarter end, many institutions were in blackouts. So this really created a situation to step back and think a little bit. Okay, what do we do during these periods where there is a blackout and the bank can't go in, or you may have officers or directors that want to buy stock and they can't? That's one of those things that you really want to talk to your counsel about in a better market environment, obviously, and get some guidance. How do you deal with that during these periods of times, and how do you approach the markets during your blackout periods? Going back through the buyback in the insider period, something to think about is some blind trading plans or 10b5-1 plans that allow you to continue to buy. Now, with those, we need to be a little more forward-thinking. So we want to make sure that we're doing those in open windows where we can think ahead of, if markets do get volatile, what that looks like. The other thing you want to make sure is make sure that you are covering that you're blue skied, exempt in your own state, that you're and that has to do with the state registration. If you're a bank, you're already exempt, but if you have a holding company, you may have issues there. We can help you walk through that. If you're on OTCQX, you automatically are blue skied in 36 states, and 33 if you're on QB. So those are some things that take that they're going to help you along the way, because if you're not blue skied in your own state or in other important states, it may be difficult for an investor to buy your stock. For more information on that, you can always talk to me or Tom or Laura directly, and we can run a report for you and give you some insight on your state. And then finally, one of my favorite comments here is, this is a great opportunity to make every client a shareholder and every shareholder a client. Looking at your shareholder base right now in this environment is key. Who owns your bank? Is it mostly institutions? Is it mostly individuals? Is it a good balance between the two? And I think digging through that is going to help you quite a bit. The shareholder makeup or landscape makes a huge impact during markets like this. If you have a shareholder base that's all local owners, you may not see much of any impact in a market like this. Whereas if you've got larger institutional ownership, you may see more volatility. This is a great discussion to have around the boardroom table. Well, actually, before I move on, Tom, did you have any comments on that slide?
No, I'd like to reiterate your comment about the shareholder base and spend some time with it. And I would say absolutely, we've seen very little selling from the local shareholder of getting out of their own bank. And I think that the further you get away from that, the more volatility, at least in this market, we've experienced. You've had the local shareholder really has not participated in this. You go out a little further, and maybe you've got people with a portfolio of bank stocks, or we kind of call them professional investors. Those guys were a little more active. They were a little bit bigger sellers, and then further out to some of these small institutions who had redemptions and had a need for cash, and they were probably the biggest seller of all. So that's no one is better than another, but it is important, to your point, for the board to kind of figure out who they're targeting and how they want to build that base.
We're here to help. And the more that we can help you, the better it's going to be for both us and you. So, when you're looking for a deep dive into your different issues of your stock specifically, I encourage you to call a member of the community bank group. If you're not sure who your advisor is, just give us a call. We'll make sure you get connected with the right individual there. But whether it's analyzing your trade data and seeing really what's happening with your stock, looking at your shareholder base, working with you on the board side, we're here to help, and we're your partner in this. Laura, back to you.
At this time, this concludes today's presentation. I'd now like to open up the conversation for any Q&A.
We've received the following question. Given current valuations and all the negativity surrounding bank stocks, we agree that there are long-term benefits to having someone who trades our stocks on a daily basis and who knows our bank story, reaching out to our shareholder base. Can you briefly describe how you will approach this interaction with our shareholders and how this benefits our shareholders? I think for this question, I'd like to invite Mike Akampura from our Jacksonville, Florida office to comment. Mike, are you on the line?
Yes, I am, Michael. Thank you very much. Right now, the current situation in community banks is that we have a tremendous disconnect in the trading markets of the OTC listed community banks that we've gone through in this presentation. That is that can be quite, I could say, quite frightening or discerning to the average individual out there that is just hearing negative news and who is, just seeing the price of their stock continue to decline and decline. And I can tell you by the amount of calls that we get from time to time from our clients who are invested in community banks, this is a main concern. And as we've discussed in this presentation, it's also something that is typically occurring on extremely light volume and not a tremendous amount of participation from individuals. As a matter of fact, for this group, I would say probably 95% of the people who have invested in the community banks have not called and have not sold, and there are just a few who have called and have sold, but not in the percentages that you would imagine. So, for over 35 years, one of the ways that I've built my practice is working with the community banks, but more importantly, re-engaging shareholders of community banks. And the point is that if you have someone who actually makes a market in your stock, is aware of the daily trading in your shares, understands the community bank space as deeply as we do, but who also can be a point person that your shareholders can call in times like these, and who especially understands the long-term value of community banks. It's now is especially and essentially a time that you should be that you should be taking someone who's willing to do that with you and embracing them and bringing them under your umbrella, and that is something that we do. Thank you, Michael.
All right. Thank you, Mike. Much appreciated. One other question we've received is, why can't a market maker support our stock if they know that we as the issuer, have been buyers? One of the problems we run into, as we referred to earlier in the presentation, is the speed and the manner of orders. Quite often what happens is we have orders come in such a quick pace or quick manner, the traders have very little time to react to those. We absolutely know that there may be buyers of the stock at the certain issuers, but it all boils down to time. And if we have an order coming in that, say, it looks like it's 500 shares, but maybe it's 50,000, a lot of times it's just really difficult to be able to reach out. One of the things that we had here in this type of situation that we're referring to now is somewhat of, again, the perfect storm, where many of our buyers were in blackout periods or were not able to buy the stock. And I think that just made the problem within the market that much worse. The other thing that we have is that we deal with today versus in the past is the electronic platforms that come into the market so rapidly that we just don't have the reaction time. Again, these systems are designed to move extremely fast, and that's by design. And so that's why within a mere 10 to 15 to 20 seconds, your stock can take a 5, 10, 20% drop by the time we get to the screen to look at it. And it's just the manner of the trades that we run into with these type of orders out there. Thank you. Okay, for our next question, we have, how does the bank initiate a buyback, and what are the rules and restrictions? For this question, I think we'll invite Troy Carlson from our Red Bank, New Jersey office to comment. Troy, are you on the line?
Yes, thank you. Your board of directors will authorize the repurchase, typically as a percentage of shares outstanding or a total repurchase dollar amount. The bank may enter the market to repurchase their shares after cooling off period following an earnings release or your quarterly filing. The 10b-18 safe harbor rules govern how and when the bank can execute on behalf of themselves while in the open market. If there are any additional questions regarding share repurchase activity or the safe harbor guidelines, please contact your D.A. Davidson sales representative. Thank you.
All right. Thank you very much, Troy. I appreciate your comments.
This wraps up our Q&A session. Thank you again for joining the OTC Markets and D.A. Davidson today. Please do not hesitate to reach out to myself, Michael, or Tom with any additional questions. And thanks again for joining us. Please continue to stay safe, and we are thinking about the banking community.